Thank you, Nitin. Thank you. Vinod is just going to join us in 4 5 minutes. Um, it seems like this panel is keeping people from their drinks, so we'll try and keep this short. Uh,
Hello.
this is all about where the
Hello.
money is going, especially on the listed market on office side, which is the REITs and retail, and also INVITs, a little bit of INVITs, which is the infrastructure side of things. So we've just released a report as well, so you guys can read it leisurely. But since 2014, government was trying to bring in the first draft. 16 they brought. Then finally we had the first REIT in 2019, and now we have five of them listed and trading on the stock exchange. Four of which are office, one is retail. Uh, Interestingly, about almost 200 million square feet, actually 178 million square feet of office building plus retail is already listed and traded out of the total about 1 billion square foot between the top seven cities. Um, and I can tell you before we start, and I'm going to ask Nitin to talk about it. This is a question. He said, don't bring things that you've not discussed. So I'll start with things that we've not discussed. Um, since the peak of stock market in September 2025 to now, Nifty has gone down about 3,000 points. BSC index has gone down 27%, but REITs are down only less than 10%. So it's ranging between 5 and 9%, but they have shown great stability. They seem to be sticking despite all the bad news that we are getting from, the war, slowdown, etc. So Nitin, how do you decode this? Why are these so sticky?
No, so it's good to see that they are as resilient as they have been, because that's essentially the nature of the beast. Uh, they are REITs are products which have got a very high visibility of future cash flows, which are very predictable and therefore tend to fluctuate much lesser. There is a growth element in REITs as well. Essentially, REITs are a yield plus growth. The yield is very predictable because it comes from lease agreements, underlying lease agreements with, grade A tenants. And the growth element also comes from a very visible set of drivers. The growth comes from underlying escalations. The growth comes from mark-to-market potential. It comes from vacant space which is already ready and just needs to be leased out, or it even comes from underutilized or unutilized FSI which gets built out. So given that they are very predictable cash flows, investors can wrap their heads around valuing them much better, and therefore you most definitely should see lesser volatility from REITs than equities.
Absolutely. I mean, very simply put, they are like a FD plus program where you keep getting some dividends in your bank account every quarter. And of course, there's an upside which is not there in FD, but in hopefully through capital gains, through re-rating of rents, through a liquidity event, something can come up. So there's a hope certificate attached to a REIT which is not there in FD. So in some sense, it's a very simple product. It is not complicated. Sirish, you want to add something on this? You're running one of the largest REITs.
Yeah, no, I think it's very similar to what Nitin said. Yeah, we are stable, right? I mean, the luck, if you want to call it, is that the portfolio consists of stable assets with a lot of long leases. So therefore, there's clarity of cash flow, and because there is clarity of cash flow, there's stability, and I think that's what's helped in this environment.
Okay, I had a few questions for Vinod, but we'll take his inputs when he comes. But let me redirect this to you. Um, all the stability comes from occupiers being in those office buildings, right? And with all this global turmoil, are you seeing any change or any impact of how the occupiers are reacting to this? either negatively or positively, the impact of the war in the West, Middle East?
I think I should say that I'm very happy that I am not seeing any reaction, because you want to try and have the global capability centers stay and not be disappointed or dissuaded by the current situation, right? So I think the fact that we have not seen any reaction is it's a good thing. I think longer term though, what you will see is that it's very clear that the Middle East especially is now, just going to be considered a unstable region, I think, for some time. And I think the stability again and the democracy and the way India has handled things, where we stand today, I think will help in the longer run. So I think even, offices or data centers or other sort of products which were contemplated for the Middle East region, I think will think about coming to India more than going there. So that's the benefit longer term. I think shorter term, it's stable. We have not seen any decisions really get changed dramatically. I think that's a positive. I think what has happened is certain decisions which could have been made in March, I think there has been a push into April and May. So there's slight sort of push in terms of timing, but I don't think there's a longer term impact yet.
Saying demand is staying, but decisions are getting pushed out. And sorry.
No, I was going to say a little bit. Not like everybody's pushing, but some decisions have got pushed out from March to April. Yeah.
And Nitin, on the same note, what's happening to FII flows on the market in general and also specific to real estate? Are the foreign investors and institutional investors looking to double down?
So, I mean, if you think about it, India is very much still in the emerging market bucket. So when the world goes risk off, you tend to, there is a flight to safety, and therefore there is a sell-off in broader emerging markets, and India is no exception, and India does get impacted by that as well.
Yeah. Welcome, Vinod. We're just starting, but we are missing you. So welcome to the stage.
So just to continue on that, broader markets, we've seen one of the biggest record sell-offs in the last month. I think we saw FII outflow of about $12 billion in the month of March. And that's a significant number. But if you talk about real estate in particular, I think institutional investments in real estate have been more resilient. I think we've still seen about $1.4 billion of institutional money coming into real estate in the first quarter. But the color of that money has changed. I mean, just to give you an example, all of 2025, we saw $8 to $10 billion of institutional money in real estate. Maybe 55% of it was domestic, 45% was still foreign. That ratio in this first quarter itself is more like 75-25 in favor of domestic. So foreign money has, and it has been coming down. Even if you look at 2025 over 2024, domestic capital would have doubled, but foreign capital would have still fallen maybe 15-20%.
So you're saying the trend was anyways there.
Absolutely.
And this whole war thing has added to that.
Absolutely.
But sell-offs will continue and rupee will continue to prop it up, but let's see how long it goes. Vinod, welcome. We were just sort of talking about the first agenda point only. And Sri said we are discussing the impact of the war and what it's doing on the occupiers and demand. So Sirish's view was that some decisions have got delayed, but the demand has not disappeared. And Nitin was saying foreign investors are backing off, but there's enough domestic money that's coming back. So my question is twofold to you, Vinod. One is the impact of war and how you're seeing your occupiers react to it. Is there any negative reaction or a positive reaction? And second, I'll also, since you're sitting here and this gets asked, you can't talk about REITs without talking about AI and its impact. So how is AI impacting the occupiers? So both the questions to you and Sirish.
So I think real estate is far more cyclical in a long-term manner than smaller impacts which kind of will keep coming and going, because the world is not going to be a a straight line place for the next 10, 15 years at least. You're going to see volatility and unpredictability in the world environment. Having said that, I think two things. One is it's a great thing to see domestic capital finally believing in real estate, especially in annuity real estate and commercial real estate, which was a vacant space where global capital grabbed all the opportunity, right? And now you're seeing the reverse of that. It doesn't mean global capital is not actually coming in. Global capital is just recycling their money. I think in another couple of years you will see them back again. Because these are long-term opportunities, and they are one round of investments which built the last 15 years from literally 100 million square feet worth of grade A to 4, 5, 600 million of grade A now. It's actually contributed because of global capital, right?
That's right.
Having said that, when we look at the demand cycle, I don't see any blip in the demand currently. While there is a whole overshadowing discussion around what AI will do and can do, nobody has a straightforward answer to it. But the GCC demand on the ground still continues to be very strong. So I think 2, 3 things will happen. Grade A plus office for the next 5 years, I don't see a challenge. Even if you see AI disrupting some jobs, it will certainly. But what it's going to do is multifold improve the efficiencies of output. So today we were looking at Fortune 100, Fortune 200, Fortune 500 companies coming to India. Now, if you ask me a list of 20 clients that are looking at spaces with us in different parks, I've never heard of those names. But when I start searching those balance sheets, they are $50 billion, $70 billion company, $100 billion company. I've never heard of that name. They are coming with 500 seats and 1,000 seats. So it's actually phenomenal that India is at the pivoting point. While we are saying AI will replace jobs, but for extracting AI, you need some level of talent. That talent is not there anywhere else in the world. All the work is coming here. So in a weird way, while AI will take jobs away, far more number of people will be dependent on India to give them the refined output that AI can produce for you. That talent pool doesn't exist anywhere else because the learning curve is here. So while you will see that chop and change, you will see a reshaping of the workforce. I'm not saying it won't be disruptive, but it is going to be greatly opportunistic for India. And because of that, you will be willing to pay much higher value because you'll be giving far greater output. For that, you will go to grade A plus because you'll want to target grade A talent. So for grade A asset, right in the quadrant where there's infrastructure and all the other tailwinds, you will see serious amount of demand upswing. What we are missing out lastly is, we've always been dependent as a country on outsourcing. If we believe we will be between a 5 to a 10 trillion economy, give or take a couple of trillion plus minus, I think domestic demand of another 30, 40% layered to this demand will start becoming visible. You will see domestic capital wanting long-term leasing, long-term asset buy for their own office and growth. And we are already starting to see that. We are missing that bus. That bus is going to really build on the commercial demand cycle.
So you're saying there's a massive sort of demand sitting internally that's going to consume a lot of the new offices that are coming up. And of course, you said GCC is there. And I'll also add to that saying, yes, new companies are coming in. These are not the Fortune 500, but maybe the next layer. But equally, data centers are getting relocated, and what's happened to Middle East, I think we met virtually all the big consumers of data centers in the last 2 weeks. They are having to double down because they have to build spare capacity beyond Middle East. So in that sense, there is demand that's coming our way in offices. So hopefully we want, Sirish, you want to add something to this?
No, I think Vinod spoke very well. I think we see the same, and that's what I told you, that even despite the war, etc., we have not seen any decisions change or any sort of momentum change in terms of the GCC space. I think we are in for a very solid run. And yes, there is a lot of focus on AI, but as Vinod pointed out, that there is also a lot of jobs being created which are, very specific to the fact that AI to be adapted across the world does need a lot of work. And that work and that talent, as Vinod pointed out, is here. And that's why we are seeing a lot of these, $50 billion companies, but new companies also hire and engage people here. So I think it's fairly positive. We should not be, overly negative about the AI scenario.
I'm going to take on from where Vinod sort of hinted, saying there's 600 million square feet of pure grade A office space. And I had mentioned before that about 170 has got piped into REITs. Nitin, you've done a great job. You've participated in all the 4-5 listings. I'm sure you're looking at few more. What will it take for more of these companies to come in? Is there an issue or you'll see more listings happening on the office side, and maybe you can comment on retail, and Vinod, you can also join in on retail since you build a lot of shopping centers as well.
No, for sure. I mean, REITs as a product in India is still very nascent. Yeah, we've been here for 6 years. We've got 5 up and running, but in the larger scheme of things, it's still new. Every month you hear about additional sort of investor sets that start warming up and start understanding this product. So the demand for investing in stabilized annuity-backed assets is very, very real. I'll just give you one statistic. If you look at the period of, say, 2010 to 2019, which is like your 8-9 years just before the first REIT, if I look at the fundraising that happened in capital markets as a corollary, I think we raised about 5,000 crores only. And this is for all real estate, hotel, all of that put together. But out of this 5,000, 75% was for developers. Only 25% was actually annuity backed. Now fast forward from the first REIT to today, which is from 2009 till now, fundraising in capital markets has gone 10x in this period. We have raised about 50,000. But almost 80% of it has been annuity backed. So investors have been able to wrap their heads around, again, predictable cash flows very easily. And that's why I think this product is going to still see a significant growth from even here. Yes, a lot of the grade A assets are still in office because that's really been built out very fast and in a very consolidated manner. I think it's just a matter of time before other segments also come to market. We have one retail REIT. We have a couple of other listed developers who have retail. I mean, if I just think about it as a listed versus non-listed, I think you can safely say about 1/3 of grade A retail is already listed. But there are portfolios out there which probably are not ready yet for a REIT because it's in terms of scale just not there, or the sponsors are still in the build out phase, and therefore you don't want to do a REIT just now because you'll have to distribute the cash flow and you'd rather use it for growing the portfolio further. But over time, eventually, I think all of these will come to market in a listed form. Either some will go the REIT way because they want to monetize. Some may even do an equity IPO because they need the capital to grow further.
One way or the other, they're going to hit the stock market, whether it's a REIT or listing. Vinod,
I hope so.
Vinod, your comment saying, how do you see the other side? So there's almost 300, 400 million square feet. Is that going to get consolidated in the 4 REITs that are there, or they're going to do a separate REIT? How do you see this sort of balancing out in the next 5 years?
I think it'll be a combination of many things. It can't be, it'll be healthy if you have 10, 15, 20 REITs in the marketplace, right? But to reach that scale, each one of them has to have 30, 40 million square feet so that they can constantly provide that growth and trajectory. And a lot of the assets are sitting on strata ownership. A lot of those assets have to go through a lot of churn. Some of them will get demolished and rebuilt for some different asset class, or retrofitted, or transacted, bought out, because infrastructure is playing out very differently. So the dynamics in each market will change depending on how infrastructure aligns. Having said that, it's not just commercial real estate. You will have hotels as REITs, you may have malls as REITs, you will have hospitals as REITs, you could have education as REITs, student housing, and then you might even move to senior citizen housing. Anything that really establishes annuity. Globally, residential REITs are huge. In India, because the yields are still really small, it's not yet there. But I think 10 years forward, you might have residential REITs that will dominate the market because everyone wants to have a share of being able to participate in real estate. Commercial real estate, not too many people have understood. Now, of course, the participation is much, much more than we got listed. And it will keep rising because people have realized the value of annuity and total growth. So I think it's a long play, but it's a play which is going to continue to remain exciting.
So new asset classes.
I just wanted to add, Shobit, what you have seen, as Nitin said, is that the capital markets have matured. They've really matured. And, insurance companies, I mean, it is as a block looking for stability, yield, and this product really helps, the insurance companies to invest. So 10 years ago, the amount of capital an insurance company had versus today, I mean, we were last year out on roadshows, and I was just shocked at how many insurance companies were out there with at least 25,000 crores corpus or higher. I mean, LIC obviously, was limitless, but there are many, and those over time, as Vinod was pointing out, only going to grow, right? So as these grow, as that source of capital becomes available, so as Nitin was pointing out, it's really domestic capital. So you've got the SIP and the retail investors sort of coming in. You've got insurance companies and other institutional Indian capital sort of coming in. And then you've seen this real increase of family offices, high net worth, looking for yield, that product maturing as well. So when you put all three together, you really have a lot of capital. And when there is capital, I think Indians are smart enough to sort of figure out how to get the collateral. And it may not happen in many new REITs because, Mindspace, whether it's Knowledge Realty, we will look to acquire. And one-off assets, 2, 3, 4 assets, it's hard to get their own REIT going. So those will become, sort of merge into our collateral. But then there are other developers. I mean, Bagmani is one, as you know, which will come at some point this year. There will be other retail, other developer plays like that will happen over time.
You're saying some consolidation and some new REITs coming in, so it'll continue the momentum. Nitin, I want to bring you in, continuing from where Vinod left, saying there could be other asset classes that will come in. I know you were in Delhi yesterday talking to the government about government-owned assets. What do you think about this? You've just fresh out of that conversation.
No, so I think if you look at the last budget, the government did announce a plan to monetize or retize. They've actually coined this term called retization of non-core assets for CPSEs. And yesterday they had a workshop where it was very encouraging to see, more than 150 CPSEs actually participate and try and understand how do they go about identifying these non-core assets and, structuring the holding in such a way that they can actually REIT it out. It's early days. But I think the opportunity is immense because most CPSEs, as you can imagine, are sitting on really extremely centrally located but underutilized assets which are probably not grade A today but hold that potential. And the entire sort of endeavor is going to be to try and see how best to get them there, how best to take these assets. And in terms of quantum, I mean, sky's the limit from supply. But I also want to add that even from a demand point of view, while, even Shirish alluded to the kind of investor classes that he's seeing, like insurance companies, pension and provident funds are just about now warming up to this. We've seen them participate in some of the previous issues, but, they have actually changed their regulations and regulations now allow them to put 5% of their AUM in these
Yeah.
products. And that AUM today as it stands is 17 lakh crores. So
5% of that, yeah.
there is, more, a runway and beyond for investment into these products.
Yeah. Sirish mentioned that some of the smaller guys may not be having the scale to do their own portfolio. Either these are single asset or very small side assets, multiple assets. Our SEBI had also gotten SM REITs, which are small, medium enterprise REITs. First one of them is already up and about. Do you think that will find more traction? Or do you think what Sirish is saying, just buy them off, consolidate? What's the consensus there?
So SM REITs is even more nascent than REITs. You have 3 schemes from one REIT sponsor today. But I agree. I mean, there are smaller assets, strata sold, which today may not find room in a larger REIT, but could very well be part of a scheme of an SM REIT. And this could be, again, like Vinod said, this could go across office and malls and hospitals and hotels. There's no reason why this, cannot find room in a SM REIT. Although because of its nascency, today, I think the one bottleneck one faces is that liquidity is very limited in SM REITs. And the more sophisticated investors who will probably be the first to understand this product, for them liquidity is still a question mark. Let's not forget, all of these SM REITs were earlier, in the avatar of fractional ownerships, where honestly it was not even listed. So the liquidity was what the platform made it. Over time, as there is a lot more understanding of this product, one hopes that liquidity will get solved. And once that liquidity gets solved, I mean, it's like a hockey stick. You will see it just take off.
So these are it's a good to have, but yet to prove its worth. So let's hope what you're saying is done. I'm going to stick one more question before I pass it on. What about INVITs? There are a few INVITs which are more focused towards infra assets, and warehousing qualifies for that. At least within this larger room, there may be many people who do warehousing. What's happening to that?
So, INVITs very similar to REITs. Only a lot of the assets underlying in INVITs are, concession based. So they have a limited life, and therefore there's no capital appreciation. So the yield that they throw up is really the total return, and therefore the yields are higher than REITs. You have some INVITs which are government backed, some which are private backed. But I think the kind of stability and predictability of cash flows that they offer is as good. And which is why you've seen a lot more INVIT fundraising than REIT fundraising. I think the AUM, if I were to talk about REITs and INVITs put together, is about 9 lakh crores today, out of which only 2 lakhs is REITs. 7 lakhs is still INVITs.
INVITs, yeah. Only
because
2
the
lakhs.
asset base is much larger, and they've been able to consolidate that and bring that to market much faster.
I think we are also not doing the right job, only talking about REITs, but REITs per INVITs put together is 9 lakh, guys. It's a very, very large number. And just the REIT number itself is very big, 2 lakh crores. So the market cap of 5 REITs. And by the way, we always keep excluding one REIT, which is assets are in India, but it's listed in Singapore. Effectively, at some point, it hopefully will come back to India. Let's see what happens. But just to give you guys a perspective, India has 5. Next biggest Asian market is Hong Kong with 11 REITs, then Japan with 30, and then Singapore with 58. I'm not even talking about US because that's a completely different ball game where they have jail REIT, golf course REIT. So you cannot imagine what you can do with these assets if you really sit down and put your heads together. We are still only talking about office and retail. That takes me to the next question. Is there any, and Shirish, is there any regulatory challenge or at the moment which needs to be ironed out to see a further accelerated momentum, right? It is growing at its own pace, one REIT a year roughly since 2019. Is there anything that's going to change or that could change that could help uh, a faster piping of these REITable assets into REITs?
More than regulatory, it's more about transparency and clarity and governance. Because when you're talking of SME REITs, the biggest challenge you will face is about transparency, governance, etc. And then the biggest other factor is growth. Because if you cannot provide growth, your annuity at some point in time is going to pause. And it's not going to give you what you're looking for. So besides that, regulatory-wise, I think the government's done a phenomenally smart job of accommodating everything on the way as they saw. And they're continuing to give that support because they believe in slowly bringing this asset class onto a platform where much larger participation can take place. So I think that's on track. There are nuances, but they will keep coming and getting corrected. Yeah, sorry.
Yeah. You're saying from the first go to now, actually government has done a fantastic job in bringing in the right regulations. Of course, like I said, everything has a learning curve. Sirish, any points that you have on this? You've
No,
just
I was
listed.
going to say the same, that, if anything, the government has actually gone out of the way, whether it's classification as equity, banks now finance REITs, which was not being done before. A lot of decisions, increasing the allocation from insurance companies to invest in INVITs/REITs, and I think that allocation will grow further over time. So I think we have all the support. I think we just need to try and, get, capital markets are supportive as well. So I feel the REITs will grow, there's no question. I think there will be new REITs that will come along. I think some of the good assets are in already publicly listed vehicles. So that makes it a little tricky, whether someone, a la DLF, who obviously has great assets, whether it makes sense for them to REIT some of those assets or keep them inside the company, right? That decision making takes away a lot of the 700 million of remaining square feet that we have. A lot of the good square feet is inside a publicly listed company already, so that's something to think through. But other than that, there will be the acquisitions, as I said, of smaller assets, and REITs like Bagmane and so forth going down the road, which will further, add to the overall sort of spectrum of opportunity
in the market. I know that we can talk about a lot of things, but quickly, why don't I just start? We have lots of time. We'll probably finish earlier than the clock is talking. But I literally have one last question, which is a little bit about visioning. If we were to be here on this panel and imagine we are sitting in 2030, 3-4 years from now, what do you think a REIT and an INVIT and SM market put together could be, and what are some of your sort of forecasts around this?
I think the 9 lakh crore can triple.
Triple to
INVITs
27.
put together.
Guys, that's a big growth, huh?
I think the existing REITs are going to grow in scale significantly, and then you tack on the new portfolios that will get INVITed or REITed. No reason why this 9 lakh crore odd AUM cannot look like more like a 25-26 lakh crores.
Big round.
I was going to say double, but Nitin is being, very optimistic. Well done. Yeah. But one trend I want to point out, Shobit, and I think it's something Vinod referred to again, is A+ quality, right? If you notice, what's happened is what I would call premiumization of space has really, come to play. You are finding better and better office buildings, better built, a lot more amenities, campus-like settings, real perks for employees, and as we have discussed before, attracting the best talent has meant that the occupiers, the tenants want and demand high quality space. So the good news along with the GCCs coming is what we're seeing is the quality of space going up a lot. And I think that will continue. And I think that trend over the next 5 years will really distinguish, REITable product, good product versus non-REIT product. So that's a big change over the next 5 years.
Vinod, you?
Three, four things are going to happen. One is, as you're seeing the rent base got recalibrated, I think it still needs to get further recalibrated. That will change the base of the current AUMs. Secondly, you will see 300-400 million square feet of office getting delivered in the next 4-5 years, minimum, right? You will have another in the range of between 30 and 50 million of retail getting added in new assets, okay? And I'm just talking two asset classes. So that again will add to opportunity for some shape or form in terms of annualized annuity, whether it's REIT or public listing or whatever it might be. And then obviously you have infrastructure that's playing out. And in my view, in the next 4-5 years, you will have other asset classes also showing up in the REIT basket, not just office and retail. So cumulatively put together, I think that number is achievable.
So guys, just a big round of applause. We're saying we're going to triple the size of REIT in 4 years, right? I can grill these boys for a long time, but I think, we're going to end it here by saying great momentum. If our government only stays out of this war situation, which they've managed to do so far, I think all the predictions that people on my left are saying is going to come true. REITs is going to continue with the momentum. There is some talk about AI disruptions, but it's not enough to dislocate the demand for offices. 300-400 million square feet coming in, 9 lakh crores to 27 lakh crores or 25 lakh crores in 3 years. I think good going. With that good note, I'll probably like to end. If anybody has questions, maybe we can take one or two. Otherwise, the panel is available outside for a few questions. One or two questions we can take probably. One or two questions we can take from the panel. We have some time.
Hi, I'm Soumya Agrawal from Signature Satwa. My question is more as a point of discussion. As you mentioned, that residential REIT can be a future concept. So kind of asking your opinion more on that how do we get there? For example, you mentioned student housing, senior living, or maybe branded residences that are doing managed residences. So that can be a way forward. At the same time, how do developers kind of look forward to that or start building towards that?
I think there are multiple steps to that. Firstly, you have to build on a total return model and not just an annuity return model, because the resi will give you 2, 3, 3.5%, 4% for some time to come. So you'll have to have patient capital that's looking at total return. The other is the tax structuring and the pattern of ownership, because simply put, those assets could be a mix of getting sold at different points in time, new assets getting built and then getting leased. So that whole legislative mechanism needs to get built out. And cumulatively, the regulator and the government needs to understand that this asset class has far greater interest across the country and a far greater level of participation. So a lot of transparency will have to be brought in. You'll have to do tokenization of real estate, which digitization, tokenization will become possible. And if that happens, then it will give a fill-up to residential. So it's doable world over, it's been done. I think India will get there. Another 5 years, there will be some shape or form of legislation that will encourage this to happen.
Yeah, I'll probably just add to what Vinod was saying. I think one of the big things is that as a community of developers around here, we only build residential to sell. So we need the product to come in as well. In office, it took almost 10 years of building that product, making sure the product was right for REITs to come in, and government to gain that confidence saying, now let's press the button. We have the right product for the investors. I think in residential that will take a little bit of time. World over, like Vinod said, it's a big asset class, but our government is still to fix the regulations on the residential side.
Hi, a very quick question, Shobit, Nitin, Vinod and Shirish. I am sorry if I was not available for the entire session, though it's of lot of interest to me. as a consulting company. We have not, I'm not too sure whether we had an opportunity to learn and you were able to share your insights on fractional ownership and SM REITs. I know this is a topic on REITs, but there is a lot of confusion. I've been attending a few events where we've been talking that SM REITs has come and the fractional ownership is not the right kind of a vehicle, especially when we do an SPV. So just a very quick few seconds thought of yours will be of value to us. Thank you.
So you're right. These were all fractional ownership platforms earlier, and they were unregulated, and that was what made the regulator uncomfortable, and therefore they've been asked to move to a more regulated SM REIT regime now. Early days, I think there is scope for them. They do suffer from some disadvantages. One really was, like I said, the liquidity. The other one, Vinod pointed out, the growth element is very muted in an SM REIT because it's very single asset focused. But I do believe that investors will understand predictable cash flows. They understand already, but they're going to wrap their head around these newer products which are backed by underlying cash flows which are very much stable. So I'm very positive on even SM REITs because they are like a initial step towards bringing those assets which may not find room in a REIT altogether. This might be like an intermediary step for them.
Thank you. With that, I'd like to probably just thank my panelists here and Naritco once again. Vinod, thanks. Sirish, Nitin, thank you very much. And Naritco, thanks again for calling us.